Hi, my name is Drew, and if we haven't met before, welcome to ReadyBudgetGo. If this isn't your first visit, welcome back. Either way, I'm glad you're here. This is My Money Relaunch, a series where I talk about things I've learned as I dug myself out of debt for the second time and started gaining control over my finances. Before we go into today's topic, there's a couple points I need to cover. First, I'm not a financial advisor. This series is for informational and entertainment purposes only. Before making any moves with your money, do your own research and seek your own counsel. Second, while I'm talking, I'll be putting down stickers in this paint by sticker book. For each sticker I place, I will save $5 toward one of my big goals. Today's target is 50 stickers for $250 in savings. Currently, I'm working on replenishing my emergency fund. My savings recently took a $4,500 hit due to an unexpected tax bill, so now it's time to build it back up again. Today, I want to talk about credit scores, and this relates to the topics from the last couple of weeks. 2 weeks ago, I talked about how we measure ourselves in terms of our financial lives and our financial success, our degree of financial success. And last week, I talked about debt, the good, the bad, and the ugly. So this week, I want to dive into credit scores because it is a big enough topic that it deserves its own mention, its own separate video, essentially. And it's interesting to me how credit has evolved over the years. The first credit cards didn't appear until 1950, and the very first one, Diners Club, was the only credit card for almost a decade. It wasn't until 1958 when Bank AmeriCard, which became Visa, and American Express debuted their credit cards. Now, the original Bank AmeriCard, which again became Visa, was the first revolving credit card, and American Express was a charge card, meaning that you were supposed to pay the balance off at the end of every month. MasterCard didn't come along until 1966, and then Discover, I think, was in the 1980s. The first credit score, or the first credit cards, rather, were pretty hard to get because there was no credit scoring system. And some people were shut out of them entirely. And I'm not just talking about Jim Crow and the other things that were in place at the time, but women couldn't get their own credit cards unless their husbands kind of vouched for them. And so it's interesting to think that we are not all that far removed from those policies. We're only a few decades away from when that was a fact, that if you were a woman, you couldn't get your own credit card. You might have been able to get a credit card like at a maybe a department store, but realistically, you may be able to get credit at a boutique or something like that. Otherwise, you had to have your husband vouch for you, and if you were a single woman, forget it. So it's come a long way, but other inequities have been introduced into the credit scoring system, and I'll talk about those in the course of this video. Originally, consumer credit was subject to the 5 C's. So this is what banks looked at before credit scores became a thing. And the 5 C's were your character. This is your credit history. And credit history has been around for 150 years. Originally, in the mid 1800s, it was business to business and that kind of a credit relationship, and that was tracked. In the late 1800s, so maybe 1880, 1890, then it started to be extended to tracking consumers and how they were performing with the credit that was granted to them. So character was the first C. The second C was capacity, which is your ability to repay. This is where banks would look at your income, any other debt you had, and modern credit scoring doesn't look at this anymore. It only looks at your credit utilization, which I'll talk about again a little bit later. But so that was capacity, your second C. Third C was capital. This is your net worth. Do you have savings? Do you have other means of repaying this debt if for some reason you lose your job, something like that? That's tied in with the next C, which is collateral or security. Do you have anything of value? Do you have any assets that you could liquidate to repay whatever money you borrow in order to satisfy the debt? And then the last C was conditions. And this is what are the credit markets like? What are interest rates like? Is the loan terms okay? Is too long of a loan term and it's going to keep you in debt forever? Is it too short of a loan term, which makes the payments too high? So all of this was slowly replaced by credit scoring with the rise of consumer credit. And when consumer credit became a commodity and a huge profit center for banks, it really changed how banks looked at who could get credit, because then the goal became more people need to get credit. We're being too strict. So if these people carried a balance, obviously they paid a huge amount of interest. And even if they paid it off, there were still interchange fees. So either way, the bank was going to make money. Interchange fees, if you don't know, is what merchants pay to a bank in order to accept credit cards. It's usually somewhere between 3 and 4% of a transaction's value. Most people nowadays have some idea of the health of their credit, even if they don't know their exact credit score, which always fluctuates. It can fluctuate every single day depending on how much credit you're using, how often you're making payments, things like that. Banks have trained us to believe that this 3-digit number, our credit score, still represents our character, and much more so now that consumer credit is part of our everyday lives. It wasn't so long ago that you couldn't use a credit card at McDonald's or the grocery store or the gas station. Those were cash transactions, pretty much every once in a while, maybe a check. But by and large, credit cards were not widely accepted. Mainly it was hotels, airlines, restaurants, yes, higher end restaurants, things like that. But it kind of exploded about 25, 30 years ago, and credit cards became ubiquitous payment methods for almost anything. I personally don't look at my credit score for 2 reasons. Number one is I'm not looking to make a major purchase anytime soon. And 2, I am generally following the rules of credit. So I don't carry balances. I don't pay late. I don't violate any of the rules that make up your credit score. So I don't feel the need to check my credit score all that often, especially since it costs you to do that, right? FICO charges for it. Experian, I think, has the Vantage score. They charge for it. You can get this free through various sources, but typically they're only going to quote you 1 score, when in reality you have 3 for each, right? So you have 3 FICO scores. You have 1 from TransUnion, you have 1 from Experian, and you have 1 from Equifax. And they're all going to be different. I had a period in my life where my TransUnion score was in the 660s, and my score with Experian and Equifax was in the 770s. So it can vary widely. And just because I'm not looking at my credit score doesn't mean I'm not looking at my credit reports. So it's important to understand the difference between the two. Your credit score is just a 3-digit number that a credit reporting agency has come up with to look at all of your credit history and determine how good of a credit risk you are. Your credit report actually has all the details of those accounts that you have open, and even the ones that you've paid off. I have student loans that I paid off over 10 years ago. They're still on my credit report. They're paid, but they're still on there. It used to be that you could only get your credit report once a year from each of the 3 bureaus, and now you can get it every single week if you want. So make sure that you go to annualcreditreport.com if you want your free credit report. You can also pay for it. I don't know why you would, but you could. But if you want one free, annualcreditreport.com is where you go. So let's talk about what makes up a credit score. I'm going to talk about FICO, which stands for Fair Isaac Corporation, and this is the most common, right? So this is the most common credit score. It used to be the only one, and it was what everybody used. But now Vantage Score and some other credit scoring models have evolved, and certainly AI is probably going to change the face of this again. So FICO isn't the be-all and end-all, but it's still a pretty good guideline, and it's still what a lot of lenders use as of when I'm recording this video. So 35% of your FICO score is made up of your payment history. And so this is, do you pay on time? Have you been late? If you have indiscretions in your credit report, you've paid late, you've been in default, you've been delinquent, you've had charge offs, whatever the case may be, the only thing that is going to cure that is time. Just because you have dings in your credit from late payments doesn't mean that you are screwed forevermore. So there is a time limit on when those will fall off your report. And as those mistakes or those late payments, whatever you want to call them, as they age, they become less impactful on your score. So, in other words, a late payment that you made 3 months ago will have a significant impact on your score. A late payment that you made 3 years ago will have a much less significant impact on your credit score, especially if you've been keeping up with your payments since then on all of your creditors. 30% of your score is credit utilization, and this essentially is how much of the credit that is available to you you are using. So if you have $10,000 of available credit and your credit is maxed, you have a $10,000 balance, your credit utilization is 100%. This is expressed as a percentage. The way that you improve this is you pay down those balances. And so you leave headroom in your available credit. And this is a composite of all of the available credit to you, right? So if you have a $1,000 balance on a card with a $1,000 limit and a zero balance on a card with a $9,000 limit, your total credit utilization is 10%. Even though one of those cards is maxed, you have a full $9,000 available. So it's looking at the full $10,000 of available credit and you using $1,000 or 10% of it. 15% of your credit score is the length of your credit history. So this is how long your accounts have been open. If you have recent accounts, there will be a ding to your score. Recent new accounts, there will be a ding to your score. As those accounts age, then those dings fall away. My oldest account, I'm trying to think. I think it was a credit card that I opened in 2008. So that has been almost 20 years. But generally anything over 2 years is pretty much not going to hurt your credit score. And remember, this is only 15% of your total score. The lion's share of it, 65% or 2/3, is made up of your payment history and your credit utilization. Another 10% is the credit mix. Now, credit mix refers to the types of accounts that you have. If you have, for example, a credit card, that is one type. An auto loan is another type. A mortgage is another type. A student loan is another type. A personal loan is another type. They're looking also at how many revolving accounts you have versus how many installment accounts you have. A revolving account means that if you use that credit, right? So you have a credit card with a $1,000 limit, you charge $500 on it. How much credit is available, and how do I put this? So revolving means when you pay off that $500, that's immediately available to you to borrow again. Whereas an installment loan generally has a fixed amount that you have borrowed, and once you have paid off that loan, it is closed. And it's reported to the credit agency as closed, paid in full. Of course, if you default on that loan, then it's going to be reported as default. But credit mix is only 10%. So if all you have on your credit report are credit cards, it's probably going to ding you a little bit, but not too much. And then 10% is new credit. Now, here is something that is interesting. New credit and length of credit history are related. So if you take out a whole bunch of new credit cards, not only are you dinging your new credit metric, but you're also dinging your length of credit history metric because you're lowering the average age of your accounts. So be mindful of how many new accounts you're opening all at the same time. Again, in most cases, you only need to worry about raising your score if you're applying for new credit, and that could be a new credit card, it could be buying a house, buying a car, what have you. Otherwise, managing your credit responsibly, which is just doing what you're supposed to do, sending in your payments, paying on time, not maxing out your cards, not opening up a bunch of new cards, that will keep your credit score where it needs to be. So, that is my little spiel on credit credit scores. I could go into much more detail on this, but I don't want to I don't want to make credit scores sound like they are more important than they are. Certainly, if you're buying a house, especially a first home, then getting your credit in order is important. But if you're not in the market for a house, then doing what you're supposed to do with your money will take care of your credit score. It's not something that I would necessarily worry about. I might check it once a year, once every 2 years if you don't have any reason to check it more often. The other thing, too, that I do is I keep a freeze on all my credit reports. So anytime anybody goes to one of the credit bureaus to pull credit from me, it's going to come up as blocked. It'll say no credit history found unless I go in and unblock them. And this protects me from fraud. And it also makes sure that the accounts that are on my credit report are the ones that I know about and that are open. So I check my credit reports frequently. I let the credit score take care of itself. So that is it for this week. Next week, I am not entirely sure what the topic is going to be, only because it was inspired by somebody who made a comment on one of my previous videos, and I need to flesh out that idea a little bit more. But look forward to that next week. And for now, thank you so much for tuning in for this week's episode of My Money Relaunch. If you enjoyed it, please leave me a thumbs up, drop me a comment down below, subscribe if you haven't already, and until I see you in the next one, take care.